You tell me, why is State Farm asking for an increase?
Well, State Farm has been in some financial trouble for the last year, really, maybe even a little bit more. And 6 months ago, they asked for an emergency rate increase, which means that they're trying to not bypass, but they're using a certain part of the regulations to try and expedite a rate increase. And that was a request for 30%. And that was about 6 months ago. That's still pending. So they have not gotten that. Now we have the wildfires and they hold a disproportionate number of homes that are in the brush. This is just based on underwriting, right? They've written in areas that a lot of other companies didn't. So because of that, they're now turning around saying, look, we need that 30%, and now we need this additional increase as well to try and stay solvent.
You know how many claims so far State Farm will have to pay with these recent LA fires?
I don't have the exact number now. There are some rough estimates, but the concern is that they currently have or had about $1 billion in reserves. That was part of their filing with the Department of Insurance when they were asking for that 30% increase. And they've already disclosed that they've paid out $1 billion so far in claims. So we know there's a lot more that they're going to have to pay out. And the concern is, where's that money going to come from? Even if they were given all of these rate increases immediately, that doesn't all of a sudden put that money in their pocket, right? That just means that they can update their systems, they can change the billing, and then over a period of a year, they'll start to get that additional revenue coming in. But we have claims that they have to pay right now.
You know, a lot of the homeowners in that area were also covered by the FAIR plan. Do you know offhand just where those claims stand right now?
Yes, the California Fair Plan obviously had a lot of exposure in the area of the Pacific Palisades fire. It was estimated that they had just under $6 billion in total exposure. If you take the money that they had on hand plus the reinsurance that they had, it's right around 6 billion. The difference is that in order to trigger that reinsurance, which just asterisk reinsurance, it's when an insurance company purchases insurance to help them pay, right, for their claims, they would have to first pay just under $1 billion. And we think they have more. So, what is expected to happen is the FAIR Plan is going to go to all of their member companies, which are basically every admitted insurance company in the state. And they're going to have to get what's called an assessment. They're going to tell those carriers, look, we need money. And the carriers are going to have to write a check to be able to be sure that the FAIR Plan has enough money to pay the claims.
I guess that was going to answer my next question. Like, do you feel like the FAIR plan is in good condition to pay those out? And based on your answer right there, it seems like probably not.
Well, they don't have the money to pay it today, but they have access to funds to pay it without a problem. So the question becomes, how quickly is that going to happen? And it's supposed to happen near instantaneously. When the carriers get that assessment notice, they have to pay it right away. So the money is going to be coming in, and they do have that reinsurance as a buffer in the interim. So it's as strange as it sounds to say they don't have the money, but there's no question that they'll have it. They're both true at the same time because the cash on hand doesn't match the cash they have access to.
Can you explain the process of State Farm asking for a rate increase at this moment? And what would that timeline look like?
Well, the way they've asked for it is what's called it's an emergency request. So it does not go through the normal channels, which is probably why the first request 6 months ago didn't go anywhere. The Department of Insurance is very consumer friendly and they do not give rates out easily. You have to be able to justify every penny before they're going to approve a rate, which is important because consumers can know while their rates are going up, they know that someone has looked at that to be sure that it's actually necessary to happen. So when State Farm files with the Department of Insurance under this emergency relief, what they're saying is, look, we need money right now. If we don't have this money right now, we may not be able to pay our claims. State Farm has somewhere around 20% of every household in California insured. So we're talking about, what does that come to? Just under 3 million households have State Farm. Talk about too big to fail. So the Department of Insurance is going to have to figure out a way to give them what they need and at the same time try and keep rates at a level that is not shocking to the consumers that have to pay the bills.
And that was going to be my next question because obviously all this talk right now is very high level talk. I think for your average homeowner who probably has State Farm is like, okay, well, what does that mean for my bill? So I mean, what can homeowners expect to happen in the coming months?
I think that it's fair for everyone to have the same expectation, whether they're insured with State Farm or not. California has ranked number six least expensive place to insure your home in the country, which is kind of wonky when you think about it, because we have earthquakes, we have wildfires, we have all this stuff. And the industry's been grappling with this, and that's one of the reasons why we've seen the availability of insurance shrinking over the last few years. This was sort of the last straw, right? This is like this broke the system effectively. So we should be expecting as consumers to see more appropriate rating, if I can say that. That sounds very PC. More appropriate rating for the risk that we have. So people that are in areas that are a higher risk for fire should be expecting to pay significantly more for that. And people that are not are should be expecting to be paying significantly less than their counterparts that are in the hills. Interestingly enough, the Department of Insurance has mandated that insurance companies compete in some of those higher risk areas, and at the same time, forcing the industry to also give consumers the ability to lower their rates if they do certain things to create a safer home from wildfire, to change the type of roof, to change the clearing that's around their house, things like that.
I mean, given the state of how homeowners insurance is in the state and everything that's happened, and then we have this wildfire. I mean, is it safe to say that State Farm is not financially stable to pay out all the claims?
It's safe to say they weren't financially stable before the wildfires. They filed that, telling the Department of Insurance we are not, we don't have the money on hand to pay our exposure prior to the fires. So it's impossible for us to take away anything other than now they are in significant financial difficulties. What I'm hoping, and I suspect, I don't have any specific inside information. What I suspect is going to happen is the Department of Insurance is going to tell State Farm, look, you may not have the money in your California State Farm company, but your organization does. If you want us to work with you and give you these rate increases, we need to get assurances that you're going to take funds that are required to pay your obligations from this fire from the main State Farm companies that are outside of California. State Farm has been reluctant to do that. They've specifically said they would not do that actually prior to the fires. But I think now this is really changing things up a bit, because we can't give a rate increase unless we know that we can pay the claims that are already outstanding. It's one thing to say that the risks are higher, we need more money to substantiate future claims, but let's pay the current claims first before we even think about tomorrow.
The state put in this sustainable insurance strategy for the year, but given these fires, do you see any of that changing?
Well, it's a really good thing that those regulations changed in December, because if they were still pending, there's no chance any of that stuff would have gone through. I think the saving grace to the sustainable insurance strategy, which, as you said, is a group of about six or seven main changes to the insurance regulation in California, is once the current catastrophe gets under control, once a little more time has passed, once claims have been paid out even more, and the insurance marketplace will have a path forward. Whereas prior to these regulations, I think literally right now, we would be seeing a complete collapse of the market, carriers leaving the state left and right, because there was no path forward with those old regulations even before this fire. So after this type of a loss, there is no way that we would have been able to see any type of a future for the market in any way that we were seeing it before. Now, it's important also to keep in mind that because of those regulation changes, even as I sit here today, there are companies that are slowly starting to, get their feet wet with writing homeowners insurance again, which they haven't done in years. Now, obviously, they're not writing it in the areas that just burned. They're not writing it in those, more risky areas. But the fact that now I can tell you with a straight face that we have markets that are out there that will write a homeowner's policy if it's in the middle of the city somewhere, that's something we didn't have 12 months ago.
Last question for you, just, for any homeowner that's watching that may have had their insurance drop, maybe living in a fire prone area, may have still their insurance, but has seen drastic rate increases. Homeowners of all different backgrounds. What would you like to tell them during this time, especially with one of the largest home insurance companies asking for a rate increase when we're already suffering from very high costs already?
I think what everyone should keep in mind is that we're suffering from sort of a whiplash effect. There have been rates that have not been adequate for the exposure, and we've seen the market contracting because of that. And this is almost like well, you see, this is exactly why we've been having these concerns over the last several years. There was concern over an event happening like this. So if you have a policy, the most important thing to do is keep it, make sure you put it on automatic payment. Don't let it possibly lapse. Don't let anything like that happen. The chances of getting that policy again are pretty slim. And be prepared to see changes to the way policies are underwritten. You're going to be having the option to do things to save money, but the bare bones, the let's call it the default rate is going to be higher unless you take some proactive steps to make your home less likely to burn in the next fire.
Perfect. That should be it for me. Did I miss anything? Would have been anything else I didn't ask regarding this?
I think that covers the main points. It's, everyone really is in the same boat, even though they might not be insured with State Farm. Everyone is going to be seeing the same thing. This is not the last time you're going to hear of an insurance company asking for higher rates. This is just especially difficult because the fires were literally just contained a matter of days ago. And the idea that now we're going to be looking at 30, 40, 50% if all of these rates that have been requested go into place at the same time, it's just a really scary time.